All right, good morning, everybody. So we got tariffs started, and the market is green anyways after a little violence to the downside. We've made it through the Mag 7 group, Apple last night. We're still green this morning. It just goes to show and continues to point towards the idea that the market is not done, and the AI revolution expected to bring in so much profit to companies that the forward outlook just keeps getting pulled forward. At some point, that's going to run out, but run it while we got it. So in Japan, basically flat. UK about a quarter. Then we start getting into the Dow, the S&P, and the Nasdaq up more than 0.75%. Small caps really hanging back. So we're going to get CPI out of Canada. We got the PCE in the US. We got the Chicago Purchasing Managers Index this morning. We're going to get some Fed speakers out chipping teeth now that they're out of the blackout period. And everything should be wrapped up by around noon so that the afternoon 0-day plays still have an opportunity. China won't be back until the 5th. They're still on holiday, right? They're closed from the 28th to the 4th. They'll be back on the 5th. We are up against that critical level 6130, 6132 cog line. If we measure yesterday's range from high to low, and then we project that range, we get the 123. That's 6130. It's also Friday's close. It's also December 18th FOMC release when the price gapped down and left that big liquidity gap behind. So it's a significant level of resistance. So very unlikely that we'll make it through there on our first try, right? So we got close, started to reject. It could take multiple times before we finally make it through there. You should be able to see the players on the dome too. That liquidity should be in the queue. Above all of that, we still have the call wall 6230. We're well above zero gamma volatility trigger, the put wall. We've got all the moving averages underneath us, and that purple line there, I believe that's one of the voodoo lines, 6120. It's that kind of light pink color. It's not one of the strongest levels, but it is one. Pay attention to it, and we made it through that one. So really, once we resolve this gap, we've got one more pivot of note up here around that 5165. Let's see what that is. 6162 is the next pivot of note. We can get through that, then we'll focus on this high back here at 6180 something. Not expecting all of that in one day, right? Just one bite at a time. We have overnight volume sitting around 54,000. It's a little light, but with everything on the table today and with the tariffs too and Apple last night, seeing it a little light this morning, it's not really a surprise. We're not seeing any hedging activity to go with it, so they're not loading up. They don't seem to be concerned, at least not concerned enough to add additional hedges. All right, well, maybe we do got some hedging this morning. Take a peek at that when we're done with the ADR. So average daily range, we're at about 80 points now, 1.32%. So this is a 21-day average. Bring it out onto a daily. We're just counting back the last 21 days and asking, what's the market done over the last 21 days? How far does it move on a day-to-day basis? And that's because every market has its own pulse, rhythm, and we want to get a feel for what normal looks like so that we can try to identify when the market is making moves that aren't normal. Our normal average daily range is around 80 points. And we consider that from where we closed yesterday. And if you think about a daily chart, which is where we're at here, when a market closes and the next day it opens, it often moves in two directions. That's just the way the markets move. So that 80 points spans 40 higher, 40 lower. Combined, that makes about 80 points. That would be the distance between these two red lines here on the intraday. But what if we just move 80 points in one direction? We're not splitting the difference 40 higher and 40 lower. We're actually moving just 80 points higher or 80 points lower. So we can do that as well, right? And that would look a bit more like a day like this, where we closed, opened up the next day, and we ran in one direction without really going much in the other direction. So when we're looking at these ADR levels, that's really all we're looking at is what's the average normal move for this particular market. It's a lot like ATR, but ATR has some weighting in it. This just uses a simple, very simple average, adding everything up, right? And then dividing by the number you get. So looking at the ADR today, we're closer to the upper edge than we are the lower edge, which implies we'll hit that upper edge, but it doesn't owe us that because we still have to get through this gap, this significant resistance level, COG line 6132. To hit the lower one, we don't even have to break outside of yesterday's range. So we could hit the lower ADR and still be inside of yesterday. If we want to continue to expand and get the full ADR to the downside, we would have to break yesterday's low and Wednesday's low to get there. That lower ADR lines up with Tuesday's low. So we would still be in the week's range. But to get the upper edge, we would have to break the high of the week that we have so far and set a new high on the week. And we would have to get through all of those resistance levels that are at 6132. It's stacking up. There's a lot of resistance there. So I mentioned they're hedging. They're always hedged, right? It's not like they were running around without hedges and now they're putting some on. These are additional hedges that will expire today. So if they just left them on, they would be gone. They're not going to leave them on, but if they did, they would disappear by the end of the day. This isn't my opinion. I don't assume that they're hedging. We know for a fact that they're hedging. This is an additional cost. I know a lot of options traders like to play small hedges and, we protect our trades and defend them. And oftentimes we'll use those for profit. These institutions, these big players, when they hedge, it's all cost. It's all expensive. They're not doing it to make profit. They're just trying to limit their losses. And it always costs money. It's kind of like looking at your insurance, right? Your insurance for your house or your car, you would never consider that profit because you're going to have to lose your house or your car. And no matter how much you get in that insurance, it's not going to replace and make you whole again. You'll always be lacking there somewhere. Well, that's insurance, right? So when we see them hedging, we know that they're literally burning money because they're worried about something. So that market maker move, we can see it right here, the market maker move, is something that was thought up. It's a marketing gimmick. When Tom Sosnoff owned Thinkorswim and they were trying to come up with different ways that they could market their platform to people, they came up with the market maker move and said, we're the only broker out there that has this market maker move. You should come trade over on our platform. What it's looking at is the implied volatility average between the front expiration and the next expiration out. So if we look at the ES, today's expiration is at 12.5 and the next one out is at 10.3. The front one is higher than the next number out, and that causes the market maker move to show up here. This number on the side is a little bit of a proprietary number. They don't tell us all the ingredients that they use to get that number, but we know some of the ingredients. What they're using is the out-of-the-money options trades and the implied volatility of those out-of-the-money options. The more that these out-of-the-money options are traded, the more the implied volatility increases, and then the more the average increases. It's the way it all works, right? And then they tie it in with the square root of time, how many days to expiration, and then a little bit of formula that we don't know about, and they get that number that they need. So when we look in here, we can see the volume this morning. There's one of those hedges. When we look over on the call side, there's a lot more of those hedges. And it's that out of the money, those large orders that changed the average high enough that made it higher than the next expiration out. So it's not my opinion that they're hedging. We know they're hedging. What are they worried about? PCE? It shows that we've got Canada. We got our own US impact levels here. Some of these seem a bit high, but we got some of this data yesterday. Maybe they're worried about one of these Fed speakers. So throughout the morning, you want to keep your eye on the market maker move and continue to monitor, is the number getting bigger or is it getting smaller? We know that time is on our side. As the day goes by, the theta in this is going to start to wear on it, and how far the market could move will get smaller and smaller, because if you have less time, you have less distance to travel. But if it is continuing to grow, then that means they're continuing to hedge, and we haven't hit whatever event it is that they're hedging for. 8:30, 9:45, and 11 are the three time frames we want to continue to track to see if is it starting to shrink once we get past 8:30. If it is, then it was the 8:30 event that was on the table. That's what they were concerned with. If it's still growing after 8:30, then look for that 9:45 event and see after that data comes out if it starts to shrink. So we got the floor pivots this morning. The channel's a little wider than yesterday. Remember that yesterday was a really narrow channel. So today's wider than that, but it's still a pretty narrow channel, about 4 points, 5 points maybe. It's pretty narrow. Narrow channels imply that if we do break out, it could grow legs and run. The narrower the channel, the more likely it is that a breakout continues if we get a breakout. Now, this channel doesn't tell us that we're going to break out, and it certainly doesn't move price and make us break out. It's just giving us some insight on, hey, if we do break out, what's the likelihood that we continue to run? That narrow channel of yesterday implied that if we had broke out, it very likely would have continued with a really nice run. we didn't, but there you go. Today, it's a little wider. It opened higher than yesterday's. That's bullish. And price opened higher than the channel, and that's bullish. We're back above the weekly floor pivot, and we're outside of the weekly channel, and that's bullish. Now, we got our new high on the week. I know earlier I'd mentioned that breakout. We already have a new high on the week because we gapped down, and then we set the high yesterday for the high of the week, and we're running higher than that now. But we got to get that gap closed, and then we got to get above that level, firmly above it, completely close above it, maybe expand a little bit more. Otherwise, if we just tap it and fall, then we're just taking a little bit of that liquidity, but we're not getting rid of all of the liquidity that's up there. So here we're looking at the profile on the week, and we can see previous profiles from previous weeks. We've got a point of control from last week that lines up at that 60-31 also. So it's last week's point of control, and a volume profile's point of control tells us that's where the greatest amount of volume took place last week, is at 61.30. So last week, every time price got to 61.30, there was a lot of volume hitting the tape. It's very likely if we hit 61.30 this week, we're going to continue to see a lot of volume hit the tape. Then it's Friday's close. And it's also a cog line. It's the measured move of yesterday's 1, 2, 3, 6. And then it's the December 18 FOMC gap down. What is it, like 5 or 6 different things that are all 61.30, 61.32? So it's going to be hard to get through that. On the other side of that, however, if we can get above it and expand beyond it, it should act as a significant level underneath us too. We are outside of our own value area. 70% of all the volume this week has happened inside of this range. And we're now outside of all of that. So we want to be looking for icebergs, or in this case, ceilings, on our own intraday today to see if they're piling in a lot of volume across that high. We got the 10-day, 30-minute volume profile and TPO here. We can see a lot of that volume structure with the point of control below us, the 61.80 area. If we spend a lot of time here today chopping around that 61.30, it's very likely we're going to bring the point of control up to this location. But you can see how we've got all this volume and not a lot of trades. We've got enough green bars here that it wouldn't take much for this point of control to come up. But if you look at the TPO, it's really shallow. If this point of control was to move on the TPO, it'd likely come up to this 61.92 cog line. Certainly wouldn't come way up here. So there was a lot of volume run here, but not a lot of trades. It implies that those were big trades that came in. We're not expecting to see the point of control move unless we digest and sit at this 61.32 level. Otherwise, if we fall away or if we run through it really fast, then we'll be building out volume somewhere else, and we won't increase this shelf's volume structure any farther than it already is. We're not going to see that one get reduced anytime soon either, since it'll take until at least next week on Wednesday, maybe a little farther, before we wipe those candles out where we started getting that volume in the first place. $61.47 is the VPOC. That's last Friday's point of control. once we set that one, we haven't been back to it. So if we do get through that 61.32 today, keep 61.47 firmly in your sights. If you think about 61.50, it's a big options level. That would be like front running the options level, right? So that makes sense. You'll want that one on your radar with the expectation that 61.40, let's just round this up and say 61.48. It's right in front of 61.50, and 61.50 is going to be difficult to get through. Now, since it's Friday, we have a preview of what next week's range looks like. This is our current week's range, and there's no reason to nerd out on it, right? And try to get it exactly perfectly to the tick, because throughout the day today, next week's range is going to continue to move. That gray line is where price is. And then the green line and the red line are shifting up and down with price as it's moving, right? We can see 61.27 up there. And that's where this line is. It's where it should be. It's a little thinkorswim glitch, but it will shift, right? So throughout the day today, we can get a scope or a feel for what next week looks like. But until the close, this thing is just a preview. After the close around 4:15 or maybe 4:30, then it'll be locked like all these previous weeks are locked, and it won't move anymore. Then we can compare next week's range to this week's range. So far, they look really close, which tells us that the volatility of next week isn't much different than the volatility of this week. There's two metrics that go into the math to make this range. One is how many days do we have to trade next week, and the second one is how much volatility is in that 5-day period. We had 5 days this week, we got 5 days next week. It seems like we have about the same amount of volatility too. We're more than 0.75% above the 10-day. So we're not overbought. We're not overstretched. We haven't moved to the upside too far, too fast, and it doesn't owe us any sort of pullback or mean reversion. We're not even back to the average distance from the 10 that we normally run. So it's looking good. It's fine. It's healthy, and it doesn't owe us anything. Looking at the 10-week, we're less than 2% away from the 10-week. We're far enough away that it won't gravitate, hold us back, or cause us to dip back into it. And we're not too far away where we would need to turn around and correct or go back to it. So we're not overbought on the weekly either. We're just at a nice, healthy distance away from the 10. It's a good start. We want to keep that. Maybe even getting beyond that 2% level would be a little better. As long as we're above 1%, it's all good. So from this perspective, the market is still healthy. It's still strong and good. This far above the 10, we're not parabolic or moving in extremes. Now, I showed this 5-day chart at the beginning of the week and mentioned how we'll circle back to it at the end of the week, kind of get a feel for what changed. Looking at the sectors, we've still got issues with industrials, energy, and utilities. And technology across the top, XLK, 3% over a 5-day period to the downside. So we're still above the 200-day moving average. That's that purple line down here. But we're still underneath the 50. And we're in a megaphone pattern here, which is broadening out. It's going to break at some point, but until it does, we're just stuck in the pattern. Building materials still under the 200. Staples just trying to get back through and hold above the 200. Same with healthcare. It's back above the 2, not by much. And the 50 is under the 2 on healthcare. Energy, it's been sideways so long that the 50 and the 200 are just tangled together like a weave. Price just jumping back and forth. That's like my zipper pattern right there. So if we're going to continue to do good in the market, we got to have technology, communications, consumer discretionary, financials, the top 3, right? With chips. Although there was the hedging, no, let's say that differently. The dealer dynamics yesterday, if you've seen the posts, all of those NVIDIA trades that I was pointing out, the dealers really reduced their holdings, and they would only be able to do that if the other side of the trades were getting closed, right? Like if you buy a call, you're probably not buying a call from Joe Schmo, you're probably picking it up from a market maker. Well, they're not going to take the other side of that call and then not protect themselves. So if you were trading options on NVIDIA, the other side of the trade from the dealer or the market maker, they were covering their butt. They were hedging. And NVIDIA's got a lot of options being traded. And then there's a lot of ETFs that have NVIDIA, and those have a lot of options that were being traded. So when NVIDIA moves, the market moves because there's just so much risk tied up in NVIDIA. And until that risk goes away, every move that NVIDIA makes influences the market. Well, once you reduce NVIDIA's risk to the broader market, it can do whatever it wants. Up, down, crash, and burn, doesn't matter. Its influence has been reduced. We've seen a lot of that reduction yesterday. Is it enough yet? Well, we won't know. It's a darn good start. It was a lot of options that were taken off the table yesterday. And on the other side of that, a lot of the hedges that the dealers and the market makers need was closed. Otherwise, we're looking really good. 50 above the 200 on all 3 of these top line names. For the most part, we're holding either above the 50 or near getting back above the 50. So they look really good. We just got to keep it. And for the rest of the market, all things told, 2.5%, 2.25%. We're not falling apart. So we've got nat gas down, which now makes it down almost 11% over a 5-day period. And we've got the VIX down. If we look at what's up, chips, small cap volatility, that's one we don't see every morning. Software, technology, Mag 7, growth. It's a good start. Airlines still down. You got Jets, UAL, AAL. A lot of these guys had really had a nice run, and if they're going to top out and topple over, then it's likely going to take a little bit to get started. But they are down again this morning. Bitcoin down, so a little reduction in risk. Well, that changed considerably. It might make it back up. But if it's going to be a rally day in the NASDAQ and the S&P, then it's either going to be because those two groups get a lot of options coming in, or it'll be because we have risk-on sectors that are breaking out. So consumer discretionary, technology, financials, chips, communications, those five, the Mag 7, basically, if they're running, the S&P and the NASDAQ can break out and run. If they go sideways, not fall, just sideways, then the other sectors can break us out and run. That would be like a dirty grind higher, or the options can come in and that can break us out and run. Agriculture, pot stocks, uranium, that's not going to break us out and run, right? We need something better than that. Financials need to get up more than 0.5%. Same thing with chips or semiconductors. We need that to get into the game. We got precious metals, but not enough. There's a talk about a gold squeeze like there was a silver squeeze last year. And this is about the physical. So last year around October on the commodities side, when it came to closing out the trade, people were trying to take physical on silver and there just wasn't enough. And it caused this spike and this squeeze. Well, now London or over in Europe, there's a lot of talk about the same thing. People are trying to take physical on gold, and the wait time to get that physical asset went from 18 hours to 10 to 15 days. And that is causing more people to pile in and push against it, saying, well, I'll take it too. Put me in the queue. Causing a short squeeze. No, that's the wrong word. Causing a squeeze on gold price. How far is it going to go? And like anything else, it will pop eventually and flip. But keep your eye on that one today. So we still have the market maker move. Keep your eye on that through the morning. Watch the clock, check the news, see if we can get through this speed bump that's in our way so we can get back to highs and the highs of last week and push through and move on from there. Y'all be safe. Have a good weekend. I'll see you next week.